What's going on, everybody, and welcome back to another video. And today's not going to be a vlog. The vlog's being edited right now, but if you want to know how I got this view, how I'm in Miami and I got this nice little Airbnb right now, stay tuned for tomorrow's video. But today I'm going to be giving you guys a VIP session. Well, I'm going to be giving you a little bit of clips, not the full VIP session. If you want the full VIP session, join the team. Link is going to be in the description. You can join for $15. But we're going to be going over timing the market. The best times to get into the trades, the best times to avoid, the best times when it comes to the days of the week, the days you should be getting into trades. And I'm also going to answer the main question: can you time the market as a trader? So if you want to know, stay tuned to the video. If you want to join the team, join the VIP Trader Network, where we're active every single week, every single day, and we have sessions like this on the daily basis. So with that being said, enjoy the video. I hope you find value, and if you do, like, comment, subscribe, and I'll see you in the next vlog. All right, so what's going on, everybody? We're gonna get straight into it now, but today, like I said multiple times, we're gonna be talking about timing the market. And if I'm outside right now, as you guys can see, so if the audio gets cooked or anything, just let me know. I can easily go inside, so just let me know. But if it's cool, we're gonna stay out here. But basically, timing the market. When we're timing the market, not even when we're timing the market, when it comes to the market, when it comes to trading, timing is everything. Timing is everything when it comes to trading. I don't care what anybody has to say. Timing is everything. And why is it everything? Because the one thing about trading, everybody could have a good system, a good strategy, a good way to get in and out of the market. But when it comes to timing, you can have all of that perfect. You can know exactly what you're doing. Everyone knows that. I know Kino here, Strikes, Royal, Glory, Lopez, Assam. I know all of you have had or creating a good system that's worked before when it comes to getting in and out of trades. You all can catch trades, right? We've all caught trades, but what it comes down to a lot of the time is being right on the idea, still getting stopped out. Being right on the idea, and then getting maybe break even, and then get stopped break even before the idea plays out. One of the main things in the market is if you're not trading at the time that price is going to move, if you're not trading at the right time, that great trade idea, that great system you have, it's good, but it may not work on that individual day. And that's something I've had to come to grips with, because I've been trading the same way for a long time. I've been trading the same way for value gaps, false breaks for probably 2 years now. But there's still multiple days where, for example, like last week, where I lost all week doing the same exact thing. But you got to understand that timing is everything. There was a whole bunch of times last week where I had the right idea on where the market was going to go. I had the right idea on where price was going to go. But I wasn't right about the time. And that's the main thing, because if you're not in the market at the time that it's going to move, you can get caught in consolidation. Price cannot move. There is nothing saying that price is going to move in those environments. You know what I mean? Because if it's not the right time, we're simply not going to get enough volume to be able to get our trades. And that's the main thing when it comes to trading. We want to be able to get our volume within a good time. Nobody wants to sit on the charts for 5, 6, 7, 8 hours. Nobody wants to do that. That's the whole point that we are trading, so that we can make a whole lot more money in a whole lot less time. That's the main thing, right? We want to make a whole lot of money in a whole lot of less time. But the only way we're going to be able to do that is understanding timing the market, understanding when are we going to have the highest probability to get into the market, and when is the highest probability to get out of the market. What are the best times to trade? What are the best times to avoid? What are the best days, the worst days to trade? And then how can you time the market every day? Can you even time the market every day? That's essentially what we're going to be going over. But we're going to be talking about entries and exits, and this is going to kind of overlap into best times to trade. So when it comes to entries and exits, the same reasons I get into trades are the same reasons I get out of trades. I just keep it very simple. You know what I mean? At the end of the day, when it comes to getting in or out of a trade, the only thing we're looking for is a reaction within price. We want to see price have a reaction from a specific area that we're watching. And that reaction is going to allow us to maybe get a 1 to 2 or 1 to 3 trade. That's going to allow us to make some money. You know what I mean? When it comes to getting a trade, all that we look for in the simplest way possible is we just want to see a reaction from a specific area, regardless if that reaction gets us to break even, regardless if that reaction gives us to TP, regardless if it makes it lose. We just want to find the areas that is going to have a likelihood and have a reaction, basically. So we already know the areas that are going to have reactions. If we're not going to talk about the actual chart concepts, this is mainly timing. If you want the chart concepts, the free course and other VIP sessions, you guys know that. We know where the reaction areas are.
But now the main thing is understanding when should we be waiting for these reactions to occur? When is the highest probability that we are going to get these reactions? That is in step two, right? Because everybody can go into the market to figure out, oh, this is where it's likely to move from. This is where it's likely to move from. But if it doesn't move from there, it doesn't matter. So now you got to figure out what are going to be the best times to trade. Now, the best times to trade are going to really depend on what session are you trading. Are you trading New York session or are you trading London session? Me personally, I'm trading New York. So in my opinion, what is even going to make it the best time to trade? At the end of the day, the best times to trade are going to be the times that had the most volume. But even then, you got to understand there's going to be pros and cons to that. We're going to talk about the days you shouldn't trade because just like we want a whole lot of volume, if there's too much of anything is bad. What do you think days like CPI are? What do you think days like FOMC? Those are days where there's a high influx of volume. And even though you could make money, you could have a good trade, you always got to go off of probabilities. We're not going to talk about probabilities, but that's always the main thing. So what are the best times to trade? If you're trading a New York session, you want to trade the times that you're going to have the highest amount of volume. What are the times with the highest amount of volume? This is easy because if you simply have the news tells you where there's going to be red impact news, where there's going to be high impact news, low impact news, medium impact news. The news calendars are essentially giving you a roadmap for when we're going to be getting volume. It doesn't mean we're guaranteed going to get volume, but it gives you an idea on what times to pay attention to. And you got to understand that the same times it's always the same times. The main times are going to be 8:30. Going to be times like 9 o'clock, 9:30, 10 o'clock, 10:30. If you also notice, it's like the closes and opens of candles tend to have a lot of volume. So you also got to route that with those like I said, with those news events. Because if you understand that at 9:30 o'clock there's the New York Stock Exchange open, what do you think that is? It's just there's going to be volume. That's the only thing you can expect. I don't know if it's going to be volume in my direction, if it's going to go against me, but the only thing I can do is position myself around these times. What's another time such as 9:30? 8:30. What is 8:30? 8:30 is 30 minutes after the New York session opens at 8 o'clock. 30 minutes after is 8:30. But what is at 8:30? 8:30 is always that time with news. There's always 8:30 news. Whether it's not today, there's more than likely going to be 8:30 news tomorrow, the day before that, next week. It's just a time that is always going to have news every week, every month, and it's not every day, but this is going to be a higher probability time. Regardless if you trade it, this is going to be a high probability time. There's going to be times where you wake up at 9:30 to take your trade and you missed it for the day because it happened at 8:30. Maybe it was NFP, maybe it was CPI. Days like that, 8:30 is going to have a whole lot of volume, and there's no guarantee that you're going to get any volume afterwards. It would be nice to get volume afterwards. It would be ideal to get volume afterwards, but nothing is ever guaranteed in the market. This is a probability game at the end of the day. When we're trying to time the market, when we're trying to get entries and exits, we're just trying to put ourselves in the highest probability position. When we have trades that we get to 1 to 2, or we get to 1 to 3, and we take profit, that doesn't mean it's not going to go to a 1 to 10, a 1 to 50. We just got to go based off of what makes sense right now, what will put us in the highest probability environment right now. And that's the one thing you always got to understand. So also, when it comes to the times with New York session, 9:30, 10 o'clock. What is at 10 o'clock? 10 o'clock is just like 8:30. There's always a lot of news. At 10 o'clock, there's always news, and it's not usually low impact news. These are times where it's usually high impact news. And what does that tell you? If it's high impact news, you're likely going to get a lot of volume. If you're likely to get a lot of volume, you're likely to get a trade that's going to play out within maybe an hour, 2 hours. You're not going to sit in a trade for 7, 6, 10 hours like a 9 to 5 job. That's not what the purpose of this is. And even if you are in a trade for that long, you shouldn't even be watching the trade. But me personally, I'm a day trader. Me personally, I like to watch my trades. And if I'm in a trade for 10, 12, 13 hours, I'm going to be checking up on that trade throughout that whole entire day. And that's something I don't want to put myself in. So that's why I try to trade those high probability times. So if I get a trade, I'm only going to be on the charts for 1, 2 hours, maybe 3 hours max. So I'm trying to just less is more at the end of the day. I don't want to spend all day on the charts. But the only way I'm going to be able to do that is by actually taking trades that have a high chance of being caught basically in that in the wave. Think of the analogy of your trade is like a wave in the ocean. You essentially want to put the trade inside that wave and let it flow all the way to the surface. But if there's no waves and you just put the trade in there, it's just gonna float around until a wave actually comes and slowly pushes it. But if it's consistent waves already coming, you already know it's gonna get to that direction you're trying to get. Essentially, that's just me saying you want to position all your trades at the high probability times. So when it comes to New York session, 8:30, 9:30, 10 o'clock, You could say 10:30 because there also is news at 10:30, but in my opinion, the main times 8:30, 9:30, and like 10 o'clock. Those three times right there, in my opinion, if it doesn't have a move by then, at that point, it's probably going to be a later move in the day, and at that point, you should probably maybe think about just taking that day off because that's already 2.5 hours span or like a 2 hour span that if you're not really moving yet, that's prime New York. And if you're not moving at those high probability times where there's news events, where we have the New York Stock Exchange open, what else is really going to cause it to move? Just because it can move doesn't mean it won't. We want to go off of what we can try to predict, you know what I mean? Because at the end of the day, one of the main things people always ask, can you time the market? And in a sense, you can, but you can't. We never know it's going to move. We just only go off of what's highest probability, what has happened before. Do I know my trades are going to exactly move when I get in them? No. All I know is these areas that I'm getting in likely have reactions. So that's a reason it could have a reaction again. And I know the times that I'm getting in these trades while they're having the reactions are at high probability times that tend to have a lot of volume. If they have a lot of volume, 1 + 1 = 2. It's simple math a lot of times. If you can get a trade with good volume at a good area that's likely to have a reaction, you're more than likely going to get a trade to play out, even if it's just break even. But that's why risk management is key. So when it comes to London now, because New York session, 8:30, 9:30, 10 o'clock, those are very good times. It doesn't mean it's going to be the only times that they move, but those are very high probability times. If you can't find a trade within those times, I don't know if you should be trading after or before then, in my opinion, because there's going to be so much happening within that time frame that's more than enough. Doesn't mean you'll be okay with that, but it definitely is more than enough to be able to give you everything you need. But when it comes to London session, the times are going to be a little bit different. London, in my opinion, the times I like to pay attention to is like 2 o'clock to like 3 o'clock. Why 3 o'clock? Because 3 o'clock is the London Open. So that's like the equivalent to 9:30, but for London session. That's like their open. If you ever notice at 3 o'clock on the charts, if I try to show my chart right now, here, let me try to, let's go over here. If I go to my chart over here, I'm gonna just go find a random example. I'm gonna just go to, right over here. This candle right here was at 4 o'clock. Matter of fact, this is a bad example. I want a better one. Right here. So this right here is 3 o'clock. See how price had this major push? And I'm talking about this blue candle to the left. This blue candle to the left is at 3 o'clock. At 3 o'clock on this specific day, which was London's open, so London session open, price ran above this previous high. This is during London session. So essentially the same things we look for during New York are the same things I would look for during London. But look, price ran above that previous high. And what does that mean? If you know how I trade, you know I like to look for false break scenarios. Meaning, if you look at an example like this, we have a high, price ran above that high, and dropped below it. And this up here would have been an ideal area. That's just like a trade like idea that I like to look for. But if you pay attention to the times, because this is a trade idea, right? You can find a trade like this on every time frame, all day long, all day, whatever time frame, whatever you want. But the main thing is that doesn't make a high probability. Being able to find a trade like this that aligns with time and aligns with those areas and price that you look for reactions, such as previous days old highs or lows, maybe a higher time frame for value gap, maybe a daily for value gap. You have to make price align with time. And what are good times? For London session, 3 a.m. Look at what happened at 3 a.m. We ran above the previous high and immediately reversed after. One thing I like to pay attention to in moves like this is when you get full engulfing candles. So say, for example, price was pushing up for a whole hour, and then the next hour came and it immediately dropped and ate that whole candle. One thing I like to pay attention to is where was price when it did this? What led price to have a reaction like this? Because price had so much volume and it immediately dropped. One thing you got to understand is we're not moving the market like this. Us as retail traders, us as small traders, we're not moving the market like this. For the market to move like this, there's a lot of volume. And when was this volume? At 3 o'clock. This is one example. You can go back and find them yourself. And I recommend all of you go try to do it yourself and find it yourself. Because it's one thing for me to go into the charts and show you, because I know the times it's going to move. I've watched it move. I've traded London session. I've traded New York session. I see the times that it moves all the time. But for somebody that hasn't watched it themselves, that hasn't got the experience themselves, you're not going to have the same confidence to take the trades at those times. You're not going to have the same confidence that it's actually going to move at those times. You're not going to have be as confident as me. You know what I mean? You have to see it yourself. You have to believe it yourself. You have to catch the trades yourself. You have to actually see that it's possible yourself. It's different from me being able to come to Miami and see it and me knowing I could do it versus you actually do it yourself, because then you fuck what I could do. You want to know you can do it. That's the main thing. You want to know that you can catch the trades. You want to know that you know it's possible. Just because I can doesn't really change nothing until you do it for yourself. And that's the main thing. I recommend go into the charts. Go look at the times it trades. Go look at the times price has reactions from. Go look at where it has reactions from in price. That's the main thing you got to understand. It's all there for you. I could tell you the main thing that I'm here for is to just acknowledge the fact that that's even a thing. You know what I mean? So that you can actually go now and look at it yourself and see it and actually believe it now yourself. And that's the main thing. That's the same way I learned from somebody making me aware of it until I went into the charts and actually found it myself. Same thing I'm doing for you. But now you got to go into the charts and look at it. Now for, like I said, London, I personally like 2 a.m. to 3 a.m., but it tends to have those moves at 4. But in my opinion, the main time for London is 3 o'clock. Why 3 o'clock? Because that's the London Open. The same thing for 9:30 during New York session. 3 a.m. is the same equivalent, but for London session. 3 o'clock. That hour span, there's a lot of volume. What do we know with a lot of volume? You're likely to get trades from those reaction areas. Now also, I want to put this in your mind. Just because we're trading at that time, just because it's 3 a.m., if there's nowhere within price itself that is telling you, oh, price might have a reaction from here, then there's no reason for you to take a trade. Because just because you're at a time that has high volume doesn't mean you should take a trade, because at that point you're just gambling. You're just trying to gamble 50-50 on if I'm going to be right. You need to have a reason within price itself. It's not, they can't go without each other. 1 plus 0 doesn't give you 2. 1 plus 1 gives you 2. You got to make sure always that you have those two formulas. You have to have the timing and you have to have the part when it comes to the chart concepts. The chart concept is going to give you the area that is likely to have a reaction, and then the volume, meaning what time you're getting into the trade, is going to give you the higher probability of actually being able to catch the move. Because there's been so many times I've taken great trades from great areas in price at the wrong times, and it never played out. I got stuck in trades. Price went the immediate opposite direction. But then if I would have waited to the right times, it immediately moves in my direction at that time. And if I simply just would have waited for those times, I would have been on the right side. There's been so many times I've been in a trade right on the direction, knowing where the target is going to go. It hits me, stops me out, and immediately goes my direction. All that shows me is I wasn't essentially right on the time. If I was right on the direction, that's cool because you learn from that. But if you're right on the direction and constantly still losing, you got to figure out, why am I getting in too early? Why am I getting in too late? Timing is key. Timing is everything. One of the main things that kind of keeps you structured is taking the same trades at the same time. Because if there's a whole bunch of different people taking trades at different times, taking trades during Asian session where there's not going to be volume, taking trades during New York session, taking trades during London session, all they're going to be doing is taking more risk. All they're going to be doing is taking more trades. All they're going to be doing is confusing themselves, because the same way price moves in London isn't going to be the same way it moves in New York. They have a little bit different characteristics. Price itself moves the same, runs old highs, runs old lows, runs into fair value gaps. But when it comes to the characteristics and tendencies, you could tell, like any of you guys that have been trading for over 6 months, over a year, you could tell London session, Asian session, New York session, they all have different characteristics. They all do similar things, but one may move way faster than the other. And one may have way more volume than the other. One may be way slower than the other. And what do you think the slowest session is? Asian session. There's a reason we don't trade Asian session, because if you trade Asian session, the likelihood of you being able to catch a trade, the likelihood of you being able to be in a trade that's going to play out long term, is simply just, it's not going to be there. You know what I mean? But now I'm going to talk about the times to avoid. We just talked about, what do you say? You are on mute, click here. I don't know, I think y'all hear me. But I want to talk about the times to avoid. So I talked about the main times you want to trade. If you're trading New York session, I want you to pay attention to 8:30, 9:30, 10 o'clock. If you want to even simplify more, 9:30, 10 o'clock. Simple as that. If you want to pay attention to the London session, 3 a.m. If you want to pay attention to a little bit after London session, I say 4. But the thing is with London session, I can't speak too much on it, but in my opinion, you're not always going to get a trade. You're going to wake up some days and not get anything. And you got to be okay with that. Me personally, I'm not okay with that, so I don't trade London. I just keep it that simple. So now I want to talk about the best days and worst days, because timing doesn't just go into the time of the day. Just because it's 8:30 in the morning, it goes deeper than that. Timing on the greater scale, because you got to understand the same way that we talk about time frames is the same thing with the day itself, with the weeks itself. The times of the day are just a lower time frame of the week that's ahead. You know what I mean? What's going on, Angela? My boy look like he's sad at 8:30 in the morning, going through it. But the best days, I'm gonna talk about the best days. Essentially, when it comes to the days of the week, there's gonna be better days to trade. One thing I want you to keep in mind is look at the days of the week. So think of the weekly candle in the sense of time. The beginning of the week is gonna be the open of the candle. The end of the week is gonna be the end of the weekly candle. The middle of the week is gonna be the middle of the weekly candle. Towards the middle of all candles, towards the middle of every week, price tends to slow down. It's not guaranteed, but price tends to slow down. And if you just go to any time frame, you can go and see it yourself. The beginning of the week is always open. The end of the week is the close. The middle tends to be slower. But you got to understand that when it comes to how are you going to be able to catch your better entries. So if I take this back to the charts real quick, so I can actually give you a visual. So when it comes to entering, everybody knows the analogy: buy low, sell high, right? Let me just turn this upside down like this. Let's just pretend that these two candles are where I would want to get my trade. If I want to get into a buy trade, I would want to basically have the lowest entry possible. Regardless if I can get it or not, I would want the lowest entry possible. And if I was in for sells, vice versa, I would ideally want to have the highest price possible so I can be able to make the most money and capitalize on most of the move. That's just what everybody knows. Everybody simply knows the simple concept: buy low, sell high. Now the harder thing is actually buying low and selling high. Everybody can say it. That's like saying, oh, you should have bought Bitcoin when it was $1. I mean, yeah, easily fucking said than done. I can't really do that right now. But it's the same exact thing. You got to understand, buy low, sell high is the main concept. But how do you do that? In my opinion, false breaks is one great way of being able to buy low, sell high. But when we come to the days of the week now, what is the beginning of the weekly candle? The beginning of the weekly candle is going to be the open. If we look at any candle on this time frame, any candle on this chart right now, the best possible spot to buy or sell on any of these candles will be where it's open, right? That's just simple. This is on the 1 hour time frame. But if I go to, let's just say I get rid of all this real quick, go to the weekly. When it comes to the weekly candles, on a weekly perspective, let's just say I traded all last week and it's Friday right now. If I'm looking at it like this, I'm looking at it in the span of, okay, down here on this candle would have been the best possible spot for me to buy. Up here on the candle would have been the best possible spot for me to sell. But now if you just looked at in terms of the actual candle in the week, that means Monday or Tuesday would have been the best time to buy, more than likely. And that's regardless if it's a sell week or a buy week, because you got to understand, the candle opened all the way down here. The candle doesn't open on a Wednesday. The candle opens on Monday. So if there's literally weeks where it's all going one direction, don't you think common sense would be to probably try to get an entry earlier on in the week? So what do you think common sense would be? A lot more times than less. If you get in earlier times in the week, you'll be able to hold longer. Yes, it's just as simple as that. But then it comes down to being able to actually hold it that long, being able to close that long. But when it comes to actually just understanding the concept itself, earlier in the week is usually going to be the better days to trade. Monday, Tuesday are usually going to be the best days to actually catch a trade and hold it. Why? Because if you are right, more times than less, you're going to be able to hold that trade for the most part of the week. Now, if we go on to the daily time frame, just like this. The daily time frame, you can easily say, all these times you can see all this movement, but also keep in mind where the opens are, all the closes. Price doesn't usually have a drastic drop or push from where it opens. A lot more times than less, you can see that when it opens, it has a little pullback before it eventually goes one direction. The chart concept is going to make it a little bit more confusing for me to talk about the time, but the main thing you want to understand is earlier in the week, you're going to have a higher percent chance of being able to catch a trade and hold it. It doesn't mean it's guaranteed. But if you are right, that's the main thing you got to understand. This is a probability game. If you're catching a trade on Monday, Tuesday, there's no saying that you're 100% right on the direction for the week yet. You know what I mean? Because it's still early. Anything can happen still. You can't predict the future that far ahead. You might be able to get a good idea, but there's nothing that you're 100% like guaranteed that it's going to happen. But all it is a probability chance. But if you go back into time, if you go back into the charts, if you look at the weekly candles, if you go to the daily candles, you can see that a lot of the times the low of the week tends to be Tuesday. The low of the week tends to be in the first half of the week. So with that understanding, it just gives you a better sets you to have more confidence in getting those trades in the beginning of the week. Because a lot of the time, one thing I always say about Friday, towards the end of the week, price isn't usually going to fully reverse. It's possible, but it doesn't mean it's going to happen. The main thing is when it comes to Friday, it usually continues the trend of the week. When it comes to Monday, Tuesday, it's usually getting ready to try to go towards where it's going to be going for the rest of the week. The market is all about timing. Everything is timing 100%, because one thing I want you guys to understand, to make the market not random, it has to move at the similar times, at similar areas all the time. Because if it was 100% random, we wouldn't be able to predict stuff. We wouldn't be able to say something's going to happen and then it happens after. And even if we could do it one time, that says enough. Because if you could do it 2 times, then that 100% shows you that's not random. Because if it was random, you wouldn't be able to get that lucky. And if you are that lucky, then you should probably put all your money into the charts. Real shit. At that point, if you're that lucky, apparently, we might as well put all of our money into it. Because if the market really was random, the amount of trades we've been able to predict before they happen would mean that we're fucking like geniuses at this point. But it just clearly shows that it's not random. It does the same things at the same times, at the same areas. It's just about figuring out what are those times that it's going to move. What are the areas that it's likely to move. That's all it is. It's just a high probability game. When I see a trade, all I see is, oh, we're at this time and we're at this area in price. Are we going to have a reaction? Let's find out in the next 5-10 minutes. I'm going to take a trade. Yeah, I don't know if it's going to hit TP. I don't know if it's going to hit stop loss. The same thing I did last week is the same thing I was doing 2 weeks before. 1 week I won all the trades. 1 week I lost all the trades. Some weeks are going to be moving at different times. Some weeks are going to have more volume in the PM session. That's something I can't control. You know what I mean? You only got to focus on what you can control. Because if you're focused on the things that you can't control, all you're going to be doing is losing your mind. It's like the insanity. It's like doing the same thing and expecting a different result. It's just doing the same. You got to understand that there's only a certain amount of things we can control when it comes to trading, when it comes to the market. What can we control? When we're going to get in the trade, what time we're going to get in, and where we're going to get in within the price itself. That's something that doesn't really change. That's something that static, that we're doing every single day. Same thing. But when it comes to unpredictable, when it comes to news events, that's something that we can't avoid. Well, it is something we can avoid, but that's why you don't trade it. Because if you do trade it, it then becomes something you can avoid. But the best days to trade, in my opinion, I like Tuesdays. Tuesdays tend to be days where we either create the lower high of the week. Same thing with Thursdays. Thursdays tend to be the days where we usually create the lower high of the week. And what do you think that is? That's the day after the first day, and it's the second day to the last day. Think about the weekly candle section in the 5 individual like little sections. So let me draw it out. Something like this. Let me share my screen. The visual learning is better sometimes, especially when it comes to trading. The visual is needed because this shit will complicate it. When I say it like that, I say think of a candle like this. Separate it into maybe individual portions, just like this. Think of it as like the weekly candle. So each day has like its own portion of that weekly candle, right? So let's just say, I don't know how even that is, but that's good enough for now. This is what I mean when I say think of the weekly candle in terms of like sections out throughout the day. The best times usually tend to be the day before the candle is about to end, or the day after the candle started. And why is that? It's just because you got to think of this in terms of timing, symmetry, and doing the same thing. The middle of the candle tends to be the slowest. Second to last day before the day end, the week ends tends to be days where there's a lot of volume, tend to be the days where there's reversals. What day is that? Tuesdays and Thursdays. What days tend to be slow? Wednesdays. What days tend to you never really know what the direction is going to be, but it's usually just a continuation, Monday and Fridays. Now, then again, you got to understand this is all probability. This isn't something you just go, oh, this candle looks like this, so this one's going to be like that. No, it's probability. You got to go, oh, last week's candle was bullish. It's Tuesday right now. It's 9:30. We're at this old higher low. I'm going to take the chance because the probabilities seem high for this trade. That's all it is.